Hi, everyone. This is James Miller with the Miller Group, and this is another episode of the Miller Group Real Estate Show. And today we have an excellent interview for you. We are interviewing Ben Stevens of Capital City Home Loans. And Ben, with his partner Meredith Shave, are some of the top mortgage brokers here on Amelia Island. We've worked with Ben many times on helping our buyers obtain mortgages for their dream homes here in Amelia Island, so we would highly recommend both Ben and his partner Meredith. Today's interview is actually going to be about how the condo collapse in Surfside, Florida has impacted the mortgage markets for condominiums. So Ben really gets into a lot of detail about what kind of changes have occurred since those condos collapsed and how it might impact your ability to purchase a condo by obtaining a mortgage. But more importantly, we go into what can condominium associations do to make the process of obtaining a mortgage on a condominium go more smoothly for buyers. So I think that's really the important message here in this interview is highlighting those things that condo association boards can do to make it easier for buyers to obtain mortgages on their properties. So without further ado, let's go over to our interview with Ben. All right, well, I'm here with Ben Stevens, and Ben, wanted first, we introduced you to the audience previously, but wanted to hear a kind of a personal introduction from yourself about when you came to the island and how long you've been in the business here, and anything else you think is relevant to our listeners today.
Thank you, James. I appreciate the opportunity to be here. My wife, Jenny, and I moved here at the very tail end of 2001. We moved here at the end of December to get the children in school. And so 20 years, we're in our 21st year now. And I was a mortgage banker in Atlanta prior to moving here. And I've been a mortgage banker the entire time I've been here, with some other interest as well, but primarily mortgage banking and originating for that entire time. 28 years in total. The Amelia Island is definitely home for us. We've don't want to live anywhere else, but we've seen the good times and the bad times in that 20-something years that we've been here.
And definitely different markets, as we were just discussing before we went on the air here. But we'll go ahead and jump into the topic today, which is talking about the ramifications from the Surfside condo collapse and the mortgage and lending markets. And one of the hot topics that's been discussed recently on a lot of news channels is about Fannie Mae and Freddie Mac updating their lending guidelines in the wake of the condo collapse, and in their words, combating aging infrastructure and significant deferred maintenance in condominiums. So before we get into those changes, can you give us a brief just introduction? I think most of our listeners understand this concept, but for anybody that's kind of new to the mortgage industry, brief introduction to what Fannie Mae and Freddie Mac's lending guidelines are and how they impact a buyer's ability to purchase a condo or any property.
Okay, great question. Let's start with the condo first, in general condo basics, and then we'll talk about the Surfside and how it's changed. Condo is a different type of financing, because if you're the buyer, James, and you're buying a single family home, we really only have to worry about how James is going to look, his credit, James's income, James's assets, his employment. We're just worried about James, and we're going to assume that James is going to take care of his house, which is our collateral. When James is buying a condo, and let's say he's got a 100-unit condo and he's buying one unit, we got to worry about more than just James. We got to worry about the same stuff we would with James, but then we got to worry about how the other 99 owners are going to vote when it comes time to replace the roof, when it comes time to decide about a budget and whether or not reserves are going to be put aside, the condition of the property, and just the management of the association. So Fannie Mae and Freddie Mac, the deciders, if you will, the people who make the rules for the mortgage industry, which used to be quasi-governmental agencies and are today completely governmental agencies, they look at it and say, there's risk there. There's additional risk. So we want to know more about the condos. We want to know, is there any commercial space in there? Which is very little here on Amelia Island, but in other markets you might see commercial spaces. They want to know they want to see the budget. They want to know how many people are in there as tenants, investment properties versus second homes or primary residence. All of this creates a slightly different risk profile from their perspective. One of the unique things we have, I think is unique, I'm not familiar with them being in other places, but lock-off units, whether or not there's a lock-off unit in your condo can make a difference in a Fannie Freddie approval. So that's the basis. And then Florida has a little footnote at the bottom of the guidelines. Florida has a slightly different guidelines than every other state in the union. And why would that be? Florida has this law that if a condo unit is in foreclosure or it's not getting paid and it leads to the lender foreclosing, then the lender has to make good on up to 12 months worth of condo association fees. It's limited to 12 months, so it's not overwhelming, but I don't think any other state does that, so the loan to values in Florida are different.
Would that include special assessments, or is it only? It's
limited to 12 months, so you can call it a special assessment or a regular monthly assessment. But if it's $1,000 a month, then $12,000 is the lender's full liability. But you also remember this probably because Florida is a judicial foreclosure state. It takes forever to get something foreclosed. So. And that may play into the fact that it has slightly different guidelines. So we'll probably have more condos than any other state. I'm not sure how New York City, but I just figure with the coastline, the amount of coastline that's in Florida, that we've probably got more condos than most other states, and we got slightly weirder rules. So we get slightly different guidelines, and that's been something that has affected how we focus on, how we finance condos here. I don't want to get too far in the weeds, but that's probably what you need to know. It's a little condos are different, and it's a little different in Florida for condos than it is anywhere else. To the Surfside, to the structural issues regarding Surfside, or the result of that tragic collapse of the Champlain Tower in Surfside. That was a direct result of deferred maintenance and maybe some poor structural engineering to begin with. I don't know. That's outside my field. But what we do know is a building that is on the coast that is 25, 30, 35, 40 years old and maybe older, there needs some attention. And the Champlain Tower collapse called the nation's attention to that fact. My theory on this is that Fannie Mae and Freddie Mac, or really the federal government, doesn't have a lot of power to come in and tell the state of Florida what you have to do in regard. It's a division of rights between the states and the federal government, but the federal government also can't just turn a blind eye. So they're using one of the few policing powers they have in saying, hey, if you're going to get a Fannie Mae or Freddie Mac loan, a government-backed loan or government-endorsed loan, then you're going to have to we're going to have to do a little better job of policing the structural engineering. I think it's temporary. I think it's just maybe a couple of years, and it won't. And I don't think the guidelines will go away. I think the state will catch up. And the insurance industry, because the commercial insurance industry for property and casualty that is providing the insurance for these buildings, they're going to be a whole lot more interested in this. They've got a lot more to lose than any one condo unit. So I think the insurance and the state building codes will come in and take care of this problem for us. But for now, it's what we have to live with. And so the guidelines are the changes in guidelines, which are extremely vague, and that can provide a link or some information, but it's not hard to find. It was Fannie Mae Lender Letter 2021-14. So it was the 14th letter of the year 2021. I'm pretty sure it was the Fannie Mae letter that describes this, and then there's some hot links in there that if you want to really go down the rabbit hole that are there. But what you'll find out is it's very vague. There's not a lot of real strong what you have to do. But what the lenders took away from what you have to do is you have to ask for the last 6 months of minutes from the HOA. And the underwriter's got to read these minutes to determine if there's any red flags for deferred maintenance. It could be that Mr. and Mrs. Smith's got a loose balcony on the 4th floor, or it could be that there's a crack on the walkway. It just could be a lot of things. And then whatever is mentioned there, we have to address. We have to get some further explanation, and it could lead to engineers type stuff, and letters, and that's the other item that we're supposed to request is up to 5 years of any kind of engineering reports, whether that was from the local government, the county or city or state government have required it, or a capital reserve study may have done it, or it may have just been in some of the larger, well-run condo associations. I think they have the habit of having structural engineer reports periodically. My experience thus far, I've been pleasantly surprised that most of the associations, the larger associations especially, have already addressed this. They were probably doing it before they knew what was going on. And then after the collapse, they knew what was coming. So they've been very proactive about it. And in most cases, they've already identified it. The smaller, if you've got a less than 20 unit condo association that a lot of time may be self-managed, it doesn't have a property management company involved, there's nothing wrong with that. We certainly understand it, but they also may not be as proactive on spending the money that it takes to get these structural reports.
Then it's up to the discretion of the underwriter to decide whether the reports and the plan that the condo association has is going to address whatever issues might arise?
Yes. The short answer on that one is yes. The longer answer is that not every lender is going to follow the rules in the same way. In the industry, we call them overlays, lender overlays. And a lot of several of the biggest lenders seem to have just gotten out of the Florida condo financing market. They don't announce it, they won't tell you that, but we have customers regularly, monthly, that will come in and say, I went to my bank and they said everything was going to be okay, and then halfway through the process they turned me down, and it was due to the condo. It had nothing to do with the borrowers. Right. It was because they didn't like the condo, and they'll use terms like condotel, or you can't have short-term rentals. By the way, that's not accurate. A condotel is only a condotel if it's got a front desk, a centralized telephone system, or a daily maid service. Those are real condotels. Mm-hmm. We have one on Amelia Island. The rest of them are just condos that allow short-term rentals. And there's nothing in the guidelines that prevents you from owning a condo with short-term rentals. That does not make it a non-warrantable condo or not acceptable in Fannie Freddie. But there are lots of lenders out there that will have you believe that is the case. They just don't know how to do it, or their risk managers at that bank have decided we're not going to do it, but they don't publish it very well. And if you're in an 800 number bank in the middle of Minnesota, it's not really important for you to know how beachfront condos work. You just say yes until you get to the no part. But if you're local, as we are on Amelia Island, it's real important to understand how that works. And we made that decision in 2011 to figure out condo financing, because at that moment there was no condo financing. It had just frozen up. So it took us a while, and that's how we've become as experienced and have a depth of knowledge on condos.
This is a little bit of a tangent from our subject, but you'd mentioned the condotels and short-term rentals. Have you noticed any changes, big changes, or anticipate any changes to lending practices based on the rental policy, considering how popular organizations like VRBO has become? you anticipate any changes that would affect owners or sellers? I mean, sellers or buyers?
Yes, it has already happened.
Okay.
The pandemic, maybe it was the super low interest rates as a result of the COVID-19 pandemic, and we can work from anywhere. Why are we in the suburbs? Let's go to the beach. Led to a huge increase in buyers of second homes, and so we've seen the appreciation, we've seen the business. I mean, we've been very fortunate, and it's been good for your business and mine. But the number of second homeowners just skyrocketed, and a lot of times they will live here for a couple of months, and then they'll go back to wherever their other home is, and they'll rent these properties out through the VRBO or the Airbnb. But the short-term rentals, it still hasn't changed whether or not it makes the condo warrantable. The condo is still warrantable. It is still eligible for Fannie Mae and Freddie Mac financing on that basis. There may be some other basis that's not, but on that basis, that hasn't changed. But Fannie Mae and Freddie Mac came in and changed the rules about second homes. And for the my history of time and I've been in this industry, second home pricing was roughly the same as primary residence pricing. So whether you were buying a primary residence and in November you would be getting 3.25% on a 30-year fix for a primary residence, as long as you had a conforming loan amount. And if you were buying a second home, and you would have been still getting 3.25%, same terms. As of January, the announcement came in January. The effective date became for any loan that Fannie Mae was going to be buying after April 1. So effectively, that puts us somewhere at the end of February for closed loans. They changed the pricing structure to where it looks more like an investment property. In fact, it looks just like investment property pricing, which is generally about 0.5% higher. So in that environment of where it was 3.25%, if we'd assumed no increase in rates, you're now at 3.75%. They also put pricing adjustments in place to where it's very painful to put down only 10% on a second home. 10% down second home pricing would have been very attractive. We're still talking 3.25% in November. Today, it would be probably 2% higher than that. So a ridiculously high number. Or you could pay some discount points and get a lower rate, but the adjustment is substantial. And so Fannie, Freddie, federal government are actively changing the guidelines to reduce the number of second home purchasers, or at least the number of low down payment, 10% versus 25% down payment owners of second home. And I do think it's related to the Airbnb and the VRBOs, making it easy for short-term rentals, as well as the low interest rates that we had, as well as the pandemic work from home mindset.
Okay, well that makes sense, and I think we're still just seeing a lot of demand still for that type of property. I mean, and I think that VRBO movement is going to just continue to grow. You're even seeing hotels actually using those platforms to rent out some of their properties that aren't necessarily in their hotels, but the other assets that they own. So it's an interesting concept. But is there any guidelines that have changed that maybe some Amelia Island condos are struggling with, or that you see condos in general struggling to satisfy in order to get loans approved for buyers?
Not yet. As we talked about, I've been pretty impressed with the condition of the properties on Amelia Island, the condo association properties, and as well as the management of them. But this is still fairly new. It's fairly early on into the process, and we don't run out and try to approve the 300-something associations that are on Amelia Island. I made up that number, by the way, but that's got to be pretty close. We wait until someone asks us about it, until a property is listed or maybe even under contract. We're not going to see it. We're not going to review it. We're not going to do the assessment. So it's my expectation that we are going to see a few. There are not going to be too many. There are going to be just a few, probably, that are going to have some structural challenges that are going to need to be addressed. Right. But we do not yet, I do not yet know which ones those are.
Okay, all right. What about lenders keeping loans in-house? And are there any that you know of that do that local buyers could work with in case they were trying to purchase maybe a condo that was struggling to satisfy these new guidelines, or that are lenders going to find the same faults with those condominiums if Fannie and Freddie are not going to approve them?
Well, I'm glad you asked, and this part's probably going to sound like a commercial, but yes, that is it's not a get out of jail free card, but it is a reversion to the same guidelines we had prior to the December 1, the lender letter I referenced. We call those portfolio loans, and the Capital City Home Loans has a portfolio loan that has been a lifesaver. With regard specific to the guidelines, there is an addendum to the condo questionnaire. We still get a condo questionnaire. There still is an addendum that asks the person completing the condo questionnaire, which is either the property management company or an officer of the associations, the board of the condo association's board of directors officers, who typically complete these condo questionnaires. And so there's some questions, there's an addendum that says, are you aware of any structural defects? Are you aware? And they ask the same question about 6 different times. But if there haven't been any bad engineering reports, accidents, incidents, or they're not aware of it, then that's as far as we go. We don't ask for the minutes. We don't ask for the engineer's reports. Additionally, the interest rates, as you may be aware, have gone up dramatically since the first of the year. On January 3rd, the first business day of 2022, the 30-year fixed rate in the kind of the perfect scenario would have been 3.25%. Today, that same rate is 5.25% on the same loan, same everything. So we've gone up 2% in the course of 95 days, 96 days, something like that. So that dramatic increase is tough, especially when you couple it with these other adjustments that we talked about just a moment ago for second homes. Portfolio lending is a different source of money. It's not coming through Wall Street. It's coming through a bank somewhere, and their cost of funds is not gone up as rapidly as the mortgage-backed security pricing has. And so the rate is also better. So the guidelines are easier and the interest rates are better. Compared to the 5.25%, on the same loan, you'd be at 3.875 today on a 10-year ARM. I don't want to run down the ARM rabbit hole too far, but what I mean by that is this is a 30-year loan where the rate is fixed for 10 years. After 10 years, it does adjust. But for 10 years, 120 months, you got a rate of 3.875. So that has been that product has been really the most popular product over the course of the last 60 days or so because of the challenges, all of the guidelines and interest rate challenges.
Okay. What about, are there any other changes besides requesting the 6 months worth of meeting minutes and requesting any engineering reports, et cetera, that have a major impact on the loan process for condominiums?
No, not really.
Those are really the two.
That's been it. And even from underwriting point of view, Fannie and Freddie seems to be fairly accepting of the answers. You know, it hasn't been that long, but we've done enough loans that we've seen what the Fannie Mae and Freddie Mac might push back on, and there has not been a lot of pushback. They may be having a hard time like we are about trying to understand exactly what the intentions were because the guidelines are so vague. Up to 5 years of engineer's reports, not 5 years, not the most recent one. I mean, it's just a lot of things in there that they're not sure about. So I think they're trying to address, what it tells me is they're trying to address the most obvious problems It could be geographical, and we talked about early on how things are different in Florida, but these guidelines are nationwide. I mean, you could have a townhome, a condo that is a townhome style architecture in the middle of Iowa, and they're having to go with the same guidelines that we are here for oceanfront in Florida. So I'm sure there's a lot of people in the middle of the country scratching their heads about exactly how this is supposed to work, but it is not, they haven't given it a great deal of teeth yet to push back on us. It may not matter because we're not doing very many of them because of the increase in rates, and we're not seeing that many Fannie Freddie condo loans. That will likely change. The portfolio money will probably increase. That rate will continue to go up as prime does. And the 30-year fixed money might level off and get a little easier. We might see, I kind of expect it to go back down a little bit to rest in the high fours. My experience with every financial market has been, and any reaction is an overreaction, and then there's a little bit of retracement. And so I'm expecting some retracement, but I don't know when. And certainly that's just speculation. There's no guarantees. But if we were at 4 3/4 instead of 5 1/4, and we see the portfolio arms rates go up, then we may see more of the Fannie Mae, Freddie Mac type financing, 30-year fixed on these condo associations.
Okay. Besides actually addressing aging infrastructure and deferred maintenance, is there anything condo association boards can do to make sure that they are preparing for, or to make the loan underwriting process go more smoothly for potential buyers for their properties?
Yes, they need to have, if they haven't had an engineer or architect, some architects could do it, but if they hadn't had a qualified, certified inspection of their structural aspects of their buildings, then they should be doing that. I think most of them are, but if there's anybody out there who's not, they should get in line, because I'm sure those people are very popular. Locally, there's a company that does that for a living, and they've got a pretty interesting web little video,
CSI
video, exactly, where they talk about what happened at Champlain Tower. Not that they know personally, but from an engineer's perspective and what they do know, they'll tell you what happened there. And it's a little bit of an infomercial in saying, we're the guys that can come out and check out your association if you want to know. So I would expect that they're very busy. And I think that the association, the property managers, and the board of directors should be utilizing them or a company like them.
We actually are doing a series. This podcast is a series, and the first one was with Jason Hambrick with CSI, and the next one's with Josh Martin to talk about law aspects of things. So
okay,
definitely.
Wasn't aware, but Jason and his group they know this space very well. They didn't get into it after that happened. They've been doing it for years, and so I think CSI is probably going to be busy for a while, and that's what needs to happen. Also, the minutes, they need to be paying attention to their minutes, and if there's a subject of anything that might sound like deferred maintenance, they probably should go ahead and address it. And if Mr. and Mrs. Smith's loose balcony, they may want to make a note in the minutes that this is not the case for any other units. It's specific to that unit, and it has been addressed or it's being addressed. Assuming that to be true, that would just be conscious of the fact that there's going to be some underwriter in a box somewhere reading those minutes potentially.
Right. And these guidelines apply to all condos, not just, I know some of the laws that Florida, our government's passing around, trying to pass, applies to just, condominiums that are 4 stories or more, but these apply to all condominiums?
All condominiums.
Okay.
It doesn't matter where it is or how tall it is or when it was built. Summer Woods is a nice condo that's all of them. Some of them were built within the last year, where they got their CO within the last year. Some of them were built as early as 2007, I think. 2-story, maybe 3 in some places. So it's concrete block and very well made, and that association is going to be treated exactly the same way as the oldest condo building on the island.
Okay. What other questions that I haven't thought of to ask you that you think our listeners would be valuable to them to know?
You've done a good job asking questions. I think you've hit the most of it. I think the down payment part of it is probably going to be surprising to some. Now,
is that's just different for second home purchases, or is that for any condo purchase?
That's a good question. That's for second home and investment property. Investment property has generally been there, even though 20% was an option, the interest rate was noticeably better at 25%. That is now also true for the second home. So I think there's probably a lot of listeners out there that might be considering a second home and might be thinking 10% down. And that is not going to, the cost to have that low a down payment on a second home or the condo or single family, it's probably not worth it. You need to have a little more money. Now, the good news is that there's a lot of money in the system now. There's people's savings are high. Their investments have also been high, maybe not quite as much recently, but they've got good investment. And they've got equity in their first home, in their primary residence. So the being able to tap the equity in your primary residence for the additional down payment you need on the second home is probably a smarter way. You're still leveraging, you may still have only 10% out of your pocket involved. You may not have anything out of pocket, and you just leveraged a different asset in order to get the 25% down for the new asset being the condo here. So it's still quite doable, and we will, I'm not a home equity line expert, and we have that product, but it's just not that good. So I refer to the local banks who really like that lending, that space, and there's some very attractive line of credits out there. Just be aware that, of course, if it's a variable rate, it is going to be tied to prime typically, and it is going to be going up. But I don't think it's a straight line up. It's going to go up for a while, and then it'll level off, and one day it'll come back down again. As long as you're prepared for percent and a half increase, the payments on those things are really pretty low. So we look for solutions. You come to us and you say, this is what I want to do, then my job is to help you find the solution, whether it's down payment or interest rate or any other the guidelines for structural requests. We fully support the idea that these condos need to be in good structurally sound condition, and we understand that something that's aging is going to have some maintenance requirements. But I think those are being met. I think that there's other people policing that, and that probably the mortgage industry is not the right folks that need to be policing that particular issue, and we're only doing it temporarily, as I mentioned it earlier, until the insurance and the state get their rules figured out for what to require.
Okay. Well, thank you so much for your time today, Ben. How can people reach you if they want to contact you to refinance or for their next purchase?
We're right here on 14th Street on Amelia Island. It's our office, and the phone number here is 904-301-4492. 904-301-4492, and my partner is Meredith Shade. You can call that number and reach Meredith or Ben Stevens. We are here and we are happy to help, and as I've told several people immodestly, I don't think there are any other people on the planet that know more about financing condos on Amelia Island than Meredith and I.
Well, I'll say I've had worked with you quite a bit on different buyers and whatnot, and a lot of times we get a lot of folks that are relocating here or buying a second home who have a preferred bank or lender back wherever they're from, and they typically try they're more comfortable going with who they know. And I try and encourage them to go with you. And in many cases, when they decided to go with where they're comfortable from, it hasn't worked out, and they end up coming back and going through you anyway. So I'm just echoing that you're definitely the expert here. You and Meredith here are experts on the island. So I'd highly recommend Ben Stevens for anybody listening.
Thank you, James.
All right. Thanks, Ben.